In the 1980s, the Western world watched the rise of an Asian giant with a mix of awe and genuine fear. Japan's industrial engine was running so hot that many believed it was poised to overtake the United States as the world's leading economic superpower. This boom was fueled by incredibly cheap borrowing, creating an asset bubble that eventually defied logic. At the height of the frenzy, it was estimated that this small plot of land, the Kyoto Imperial Pass, carried a higher valuation than all the real estate in California combined. By 1989, the Bank of Japan intervened. They raised interest rates to cool the overheating markets. That decision popped the bubble, causing property and stock prices to peak and then begin a long descent. But instead of a standard recession and recovery, the economy stalled. The engine froze, plunging Japan into a state of stagnation and deflation that standard interventions failed to fix. This failed recovery forced the country into 3 consecutive traps, specific economic mechanisms that behaved in ways that contradicted standard macroeconomic models. The first trap of the 1990s was driven by a mechanical failure of debt and falling prices, a concept Irving Fisher called debt deflation. When a debt-fueled bubble pops, people are left with massive mortgages on devalued assets. To repay these debts, they tighten their belts and buy fewer consumer goods. This drop in demand forces companies to drop the price of goods. While this seems like a win for consumers, falling prices actually increase the relative weight of existing debt. People spend even less to compensate, and the cycle loops back, dragging incomes and prices downward together. This spiral reached a climax in November 1997. Lines began forming in front of major banks. Japan was facing a full-blown banking crisis, one the domestic media initially agreed to ignore to prevent a nationwide panic. Government bailouts eventually stopped the banking collapse, but the math of debt deflation had already drained the economy's forward momentum. In the 2000s, the nature of the crisis shifted. Deflation morphed from a mathematical equation into a self-fulfilling psychological trap known as inflation expectations. After years of falling prices, Japanese workers grew accustomed to deflation. They stopped demanding wage increases, which allowed corporations to keep prices flat. The expectation of cheap goods in the future ensured that prices stayed low in the present. To shock the system out of this loop, the central bank invented a radical tool, quantitative easing. They used newly created reserves to buy bonds, attempting to drive down long-term interest rates and force money back into the economy. Despite this massive injection of liquidity, ingrained human psychology proved difficult to shift. The economy remained stagnant as ordinary people and businesses continued to act as if prices would never rise. By 2012, Prime Minister Shinzo Abe entered office with a mandate for radical intervention. His program, known as Abenomics, took monetary and fiscal policy to their furthest limits. The central bank pushed interest rates into negative territory and expanded bond buying until they owned roughly 70% of all government debt. In an even more radical move, the Bank of Japan began directly buying the nation's stock market, eventually becoming the single largest shareholder of corporate Japan. The government also offered massive tax cuts to corporations, hoping to trigger domestic investment. Instead of spending that surplus, businesses and households hoarded the cash, with corporate savings reaching roughly 5% of earnings annually. By the end of the 2010s, Japan had exhausted every orthodox and unorthodox financial tool in its arsenal. Yet, by traditional macroeconomic metrics, growth remained unresponsive. This diagnosis of failure overlooks a massive variable. Around the same time Abenomics began, Japan's population growth reversed. They are now dealing with a rapidly shrinking population. This chart shows Japan's aggregate GDP over the last 30 years. If you only look at this top-line number, you see a flat line of stagnation, the standard metric used to judge Japan as a failure. But look at what happens when you adjust that data for the number of people actually living there. When we measure GDP per citizen, a different trend emerges, one of consistent growth. Comparing this trend to the rest of the world proves that Japan's actual wealth generation never stopped. Their growth per person has tracked right alongside the United States and Europe for decades. The measurement illusion hides a simpler truth. Japan's economy continued to generate value. distributing that growth among fewer and fewer people. For the people living in modern Japan, the reality contradicts the narrative of failure. Quality of life remains high, crime is low, and their industries are still world-class. The demographic shift Japan experienced first is now reaching China, Europe, and North America. Japan represents a functioning model of a post-growth society, proving that the old math used to judge success is becoming obsolete.